We have made it to another Friday, which means it is time for the Commstock Channel Weekly Wrap-Up. My name is Breann Hendrickson, and as always on Friday, we have Eric with us to go over the week. Welcome, welcome.
Yeah, thanks for having me, Breann. How's it going this week?
Thanks for being on. It's been, I think I told Joe earlier this week, it's been a long week, I feel like. So
By
I'm glad
Tuesday,
it's
it was a
Friday.
long week.
Yes. November 8th through the 13th, I will be traveling from Texas to southern Indiana. I would love to stop by and capture your farm story or how harvest went. Want more information or want to schedule a day? Send an email to report@commstock.com. So, there's been a lot that's happened kind of this week, a lot of reports and everything coming out between the grains and livestock. We have a lot of points to hit, so I'm going to let you start. Let's get the show on the road.
Yeah, so this week we had some big export news, some big export rumors. We've got war headlines. You've just got a ton of stuff going on. And surprisingly enough, through all this, we had December corn finish the week 14.75 cents lower at 4.80 3/4. We did have option expiration today, so that could have been part of the anchor that was holding us back in the corn. We also have November grains going into the delivery period on Tuesday, with first notice day coming on Tuesday. But the weakness in the corn was a bit of a surprise from an ethanol standpoint. We expect some weakness in harvest pressure. We should be on the downhill slide of that at this point. But ethanol margins remain good, and I'd like to pull up a chart here of ethanol margins. This is a study put out by Iowa State, and you can see when you look across the board there, we still have in the red, our ethanol margins are really impressive compared to years gone by. Yeah, we've had higher points, including just a month or two ago, but they're still very good. And as long as the ethanol grind is still making money, they will continue to go, hopefully at as fastest pace as possible. So that should help support us. But again, the bears keep hanging their hat on exports. And we're just not seeing the daily flash sales. We're not seeing the massive quantities that we want to see. China buying, I think Justin highlighted it in a video, possibly, I don't remember what day it was, even yesterday that he recorded. And the Chinese buying, when you see that on paper, it's eye-opening. They're just not present in the market. So hopefully that will shift. However, we have seen pretty impressive weekly sales reports in corn, even without those big daily numbers coming across. Still, though, remains stuck in this trading range, and we just can't break above $5, but we still have support down in the 470s to 480. So not going anywhere. Hopefully the traders will get tired of that, and we'll see some sustainable moves to the top side. The Mississippi River should help us here. We've seen the river improve 3 feet over the last week, and I guess the Army Corps is expecting another 2 feet improvement over the next week. So now we're talking about nearly impassable to two-way traffic in 2 or 3 weeks here if things go as scheduled. And forecasted rains over the Ohio and Illinois River valleys will definitely make that happen if the rains come to fruition. So yeah, I don't know. It's been a struggle in the corn, but I think there is light at the end of the tunnel here, and hopefully, as long as we can hold support, we'll keep going the right direction there.
All right. Did soybean have a good week?
It wasn't a good week, but it wasn't terrible either. Considering that soybeans are the most impacted by what we have going on right now with this November option expiration and first notice day on Tuesday. So soybeans are the only ones that have a November contract. And so from a future standpoint, that becomes very significant for them. And it is the first month of new crop soybeans. So that is a big deal. We did finish the week at 12.97 1/4. That was down a nickel on the week, but that was after 2 really impressive weeks leading in. So to be able to hold that was good. Although yesterday it didn't look so good. Today we caught a 20-cent bounce, and that really helped the overall outlook, and the weekly finish wasn't as bad. I think a lot of that was due to pretty impressive weekly export sales. Yesterday when we got that weekly report, we were right at the top end of expectations, and we had a couple daily flash sales throughout the week that helped things along as well. Just yesterday being the last one of those. But they're just not the big purchases. Now, that seems to be anticipated maybe as early as first part of next week. I guess there's been some cancellations in Brazil on the part of China, for soybean purchases down there, and they're moving that business, or at least shopping that business, in the U.S. So there is a lot of people in the physical market who are chattering about that, and I think that was probably part of that 20-cent move that we saw today. But the underlying story remains the same for soybeans. I mean, domestic crush, we went over that last NOPA crush report. We got another one coming up here in a couple of weeks. I imagine it will be just as impressive. These margins are just astronomical. Oddly enough, meal has taken the driver's seat in recent weeks and made new contract highs across the board. And today was another blow off top. We made another new contract high in meal today. It probably is set for and due for a correction, but we should see some strength in the oil. And the reason is because when we talk about the bean oil, we should be seeing tremendous improvement for domestic demand in the market for renewable diesel. This is from the EIA. This is anticipated renewable diesel capacity. So as we expand these crush plants and we're trying to generate more renewable diesel, we have to increase our crush capacity. And at these margin levels, I just can't help but think that everyone will be all over this if they're financially capable of the expansion. And so you look, 2023, we've already seen the first step in that production expansion. We've had new plants come online as early as last fall, and another one opening as early as next week, or expected to open the 1st of November. So we'll see if that happens, or they may be a week or two late in opening. But regardless, we should see added capacity this year, and then double that capacity extension next year, and then even further the following year. So when you look at where we were last year for this crush capacity for renewable diesel, we're going to over double that in 3 years. You're talking about major demand. At this pace, we won't even have enough to sustain the low level exports that we have and still have enough soybeans to facilitate this need. So something's got to shift, whether it's the market and start rationing some of these beans, or the export demand continues to wane and Brazil takes more of the global business. So either is possible, but for now, that oil meal spread is really going to be a focal point for traders, particularly large spec traders that manage money. So we'll see how that progresses over the next couple of weeks, but it is due for a severe correction. I think that short meal and long oil could be a winning trade sooner than later. The weakness in the soybean oil could probably be attributed to some of this weakness we've seen in crude, although crude is having a really nice day today, 2.25, 2.5 higher for the day. We've seen crude fall $10 from its recent high, and soybean oil is going to struggle whenever crude's doing that. So we need to see that turn, for lack of a better term. But all in all, soybeans, they continue to struggle with resistance. We did trade November to 13.03 today, but then fell right back below $13. So we're continuing just hovering that resistance level and just can't get a breakout. Hopefully news like this and maybe some reported confirmation of Chinese buy-in will break that trend.
Let's go on to livestock. Did they have a good week?
So the short answer is yes and no. Cattle market did not have a good week. We saw follow through. We had cattle on feed. We talked about that was coming out right after we recorded last Friday. Hugely bearish cattle on feed report. You had higher on feed numbers. You had massively higher placements and lower marketings than expected. And that was even, we talked about last week. I said that if we came in at the extreme end of expectations, it was either going to be bullish or bearish. And we blew out the top end of expectations for placements. So that was very bearish. So to start the week, across the board, feeders and fat cattle gap lower to start the week, and saw significant follow through. In fact, some of the live cattle contracts traded limit lower that day. And that's something we haven't seen in a long time because we have such huge limits on the cattle anyway. So that's how we started the week. That was the tone. And unfortunately, with high price levels, when you look at high historical price levels, when you start to see signs of severe weakness, it attracts more hedge pressure. And funds were already holding a very large long position. And so when they start to feel that that's in jeopardy, they will liquidate. And so we saw a combination of both. I think you were seeing a lot of hedge pressure combined with a lot of fund liquidation. And it didn't spell victory for the cattle market by any stretch. And so November feeders traded almost $8 lower for the week again, and that's after a nice up day today. The December fat cattle closed the week 240 lower at 182.22. So this trend has continued where it looked like feeders were far overpriced and they've made a deeper correction, and fed cattle are just kind of caught in tow with what the feeders are doing, and see how bearish this thing can get. We did see weekly export sales improve this week. Last week, that was a bad number, 400 tons. We got back to 17,000 tons, which, like I said, we want to be in that 16, 17 area. And so we got back to normal this week, which that was a big deal. Had that not happened, we'd be in real trouble today as well. But when you have a market that is just in a full meltdown mode, things like that don't really factor in as much. They'll just get shrugged off by the market because it'll follow the trend more than it'll follow a little fundamental input. So we have to be cautious moving forward here. Today, feeder cattle traded higher early. You had $1.50 negative trade, then you had $2 higher trade. So they traded this wide range and ended up nearly flat for the day. You had 30, 50-cent moves today. So you can tell that the traders are trying to figure out which side of this thing they want to be on and can't really yet tell whether they want to hold any longs or just try to poke at it and see if it's going to go the right way for them. But cold storage was something else that came out this week. And I wanted to focus on that just because it seemed like traders were negative because you had a month over month increase from August to September. But I think this kind of gives you a good perspective when you look at what we've seen for the last 4 years. This is a time when your cold storage starts to increase. You beef up your cold storage, no pun intended, through the winter months because you want to be ready for grilling season and the warmer weather months when top cuts are in high demand. So the month over month numbers aren't as significant. You've got to look at the year over year numbers. And when you look at where we were at in 22 or even 20 and 21, I mean, comparatively, we're still low year over year, but we did have that seasonal increase month over month, and that was perceived as bearish by the market in general. And, it's likely going to continue that trend to the end of the year. That's what we normally do. So I wouldn't be surprised to see that happen again. But this is not a bearish thing. It's just a seasonal trend, but we're hanging our hat on every little negative input in a downtrending market.
All right, how did Hogs do? Was that the good part of the
That is the good part,
livestock?
oddly enough. This might be the first time you've ever had a report where Hogs did something good, right? December Hogs finished the week $4.47 higher at 70.47. So we've talked over and over about the deficit to cash. The futures have been holding the deficit to cash, and something's got to give. And so then leading in, start the week Monday, Tuesday, we traded lower. Then Wednesday, we had a reversal higher in several contracts, and that was kind of the trigger. We saw follow through on Thursday, follow through again today, and it wasn't 30, 50-cent moves. It was $1, $2 moves, and that's what we needed. So once we posted that reversal on Wednesday, we had a really nice finish to the week. Even though we didn't see really impressive fundamental news, slaughter's still high. Cash market hasn't really trended up much. We did see some higher trade Wednesday. And then I guess some small regional numbers on Thursday, but really all in all, the cash market hasn't kept pace. And so I was afraid that was going to keep us in check, but the market was able to sustain. Futures were able to climb higher. And I don't know if 1 week really tells us a whole lot, but if we could see follow through to start next week, that would be a big deal. And we still have, in my opinion, I think we have summer month hogs next year, June through August, that are undervalued. We are going to be short of supply by that time frame, unless they just start crawling out of the woodwork, which could happen, I guess. But we're going to have a shortage of supply, and 90-cent hogs aren't going to cut it for that time frame. We've seen June, July, we've seen those time frames trade to 130 at times. I would really think that we've got enough storyline here to see $100, $110 June, July hogs. So that's something that I think the spread action in the summer months still need to have a little correction. And hopefully we'll see that by spring, but it may take a little while to get there.
As we wrap up, the famous question I always ask. How do you feel about the week overall?
It didn't feel too bad. There, day to day, people get a little emotional. This was one of those weeks where cattle people were just devastated. But we have to keep some perspective too. When you're talking about 230 and 240 and 250 feeders, when normally those are the type of numbers you're dealing with, only you replace the 2 with a 1, you're still not all that bad off. Now, I have guys trying to figure out where to set floors and producers trying to figure out if they can meet break evens and stuff. The thing is that maybe they haven't updated their spreadsheets and they're still penciling $6 corn or $5.70 corn or even $5.50 corn. And right now corn's $4.87 cash. So there are some things that we have to consider, but all in all, I think if we see the grains turn around, we'll have a trickle up effect in the cattle market, and that could resolve some of those issues. Hogs, people in the hog industry, they've just been so browbeat by this market for months that it's going to take a lot more than a week to turn that around. So I would say my short answer is the grains felt okay. Corn needs to get something going. It'd be really nice if we could get back to last week's highs and actually hold some trade there. Beans look good, have a good storyline. We talked about the demand. So grains, positive. Livestock, still needs some follow through, needs some turnaround, but I think we'll get there.
All right, that'll do it for this episode. Thanks so much and have a great weekend.
You too, Breann. Thanks.
Want more premium content? Subscribe to the Commstock Report, where you will receive 2 reports daily. Want more video content? We are on Facebook, YouTube, and now TikTok. So don't forget to like, follow, and subscribe.